Hello and welcome. In this month's on-demand webinar, OJM Group Director of Wealth Advisors, Bob Peelman, presents 8 important questions to ask your financial advisor. These questions could be asked when interviewing a prospective financial advisor or during an annual performance review with your current advisor. It's important to note that this video is for informational purposes only, and the information may not be suitable for your personal circumstances. Please contact a professional before attempting to execute any of these strategies. If you find this information helpful, we would encourage you to check out one of our books. OJM is pleased to announce the publication of our newest book, Wealth Management Made Simple. The authors provide answers to common questions they have heard from their work with OJM clients. Topics include investment terminology, market history, tips for choosing an advisor, and more. At the end of the webinar, we'll discuss how you can get a free ebook download or a hard copy of Wealth Management Made Simple or any of our other books.
Hello, I'm Bob Peelman, the Director of Wealth Advisors at OJM Group. One of the very first questions I would be asking a prospective financial advisor if I were hiring them for my family is, are you a fiduciary? I think this is an important question because a fiduciary is someone who's required to act in your best interest and to disclose any real or potential conflicts that could affect this duty. I want to draw a distinction because a lot of advice is being delivered without that fiduciary standard. And it typically comes in the way of the broker-dealer model, which you'll notice here on the right. They are held to a suitability standard, meaning they will make recommendations to you simply based on, are they suitable for you? It could be your age, is it suitable based on your risk tolerance, but it might not actually be in your best interest. And I think that fiduciary standard is something that's extremely important to have when you're getting your advice from your financial advisor. You'll notice the advisor, it's very advice driven. On the broker side, it's transaction based types of advice. The registered investment advisor is acting in a very transparent manner. The registered investment advisor is registered with the SEC. So again, they're disclosing any conflicts that they may have. It's important to note that broker-dealers it may be confusing because of the titles they have. They may have things like investment advisor or financial advisor, financial planner, but that doesn't mean that they're still not acting as the suitability standard and not a fiduciary for you. Another important part of that is registered investment advisors typically have third-party custody of the assets, meaning your assets are held with a custodian that is not the same as your financial advisor's company, where the broker-dealer model, it's an in-house custody. So they're employed by the same place your assets are being held. Just gives you another layer of transparency and objective advice. Another important part is no proprietary products from an investment advisor, so very much an open architecture where the broker-dealer model typically will offer some proprietary products, some mutual funds, ETFs, things of that nature, where, again, it may be a good investment. It might actually still be a good investment for you, but again, it just removes that layer of objectivity if you can have the advice coming in a way with no proprietary products. That's going to allow you to know that the advice you're getting from your advisor is very much in your best interest. So again, I think this is the first question I start with when interviewing a prospective advisor. If you have a current advisor, I'd be asking this question right away to them during my annual review meetings. Another great question to ask is, do you focus solely on investment management, or do you also advise clients on other financial areas? Many times you'll have a specialist who's focused strictly on an investment strategy. It could be dividend paying stocks. They're very focused in on alternative investments or just individual stocks in general. In our view, portfolio management should work with a comprehensive financial plan. So we want to make sure that you're building a reasonable portfolio and managing it over time, but you want to hear about your cash flow. You want to understand the tax implications. Are your assets being protected? Are you using the proper retirement savings vehicles? In retirement, what is your spending strategies? Should you be doing Roth conversions, life insurance, disability? Do you have the correct and appropriate levels of liquidity? What about estate and wealth transfers or charitable giving? So when we sit down with clients at OJM, we're very much focused on this comprehensive look at your overall picture, developing a foundational plan for you that your investment portfolio will sit on top of and very much work with. So I think it's very important to get an understanding of your financial planner or your financial advisor, whether or not they're strictly acting as maybe an insurance agent or an investment manager, but are they offering these other services, and do they have a specialist in those areas to focus in and really deliver the quality advice that you will need. This seems like a very simple question, but I'm often surprised how little it gets asked. But what is your investment philosophy? This is an important question because many times your individual philosophy may not match up with the investment philosophy of the firm you're working with. And all too often, you won't find that out if you don't ask some of these specific questions, maybe 6 months down the line, a year down the line. So we really focus in on the early stages with prospective clients on setting expectations, what we're good at, what we do, what our core competency is, and whether or not that matches with what a client's looking for. So just as an example, I'll kind of run you through what we talk about with prospective clients is our investment philosophy. We're looking to start our conversations based on risk. We want to understand what your comfort level is. We call it your sleep number. We look at a very objective measure to capture that sleep number for you and get an understanding of how is your portfolio currently exposed to the various types of risk on the downside. Are you comfortable with those? And how do we build a portfolio for you that you can withstand the types of losses that you're going to have in markets during different cycles? So once we have a really good understanding of that, and we'll have a couple conversations about it, we then focus in on time horizon. And I think it's important to understand that you can have multiple time horizons. You can have a time horizon for your retirement assets. You may have a time horizon for taxable investments in a brokerage account where you may be saving for a home. Again, it's important to understand that because it's going to allow us to look at what types of changes should be made if we see an allocation change that has to be made in one particular asset class. We may not make it in a longer term time horizon, but we might if something is, say 3 to 5 years. Once we know those two elements, we're going to look at the strategic allocation. So we're going to say, if we didn't change your portfolio for the next 30 years, how would we allocate your assets based on time horizon risk tolerance? And, it could be the simple 80 stock, 20 bond. What would be that allocation? From there, we're going to look for what we call fat pitch opportunities. So where do we want to shift our asset allocation away from that neutral strategic, where we look at, we call it fat pitch, a pitch right down the middle of the plate that we want to take advantage of. It could be based on interest rates, underweighting core bonds. It could be looking at valuations in US stocks and saying that we want to underweight US stocks now. So we'll make some of those tactical shifts. And then what investment vehicles do we use? In our view, we want to use low cost exchange traded funds. In some cases, we will use actively managed mutual funds, liquid funds. And again, we'll also use some alternative investments depending on the client's net worth, their liquidity needs to implement our asset allocation. But again, this is an important question to get an understanding of. You want to make sure that if you're someone who thinks that you want stocks and you want to trade and you want to do options and you have all of these strategies that you want to do, you don't really want to get 6 months into a relationship with a financial advisor and realize that that's not what they believe in or what they do. Very important to get that right at the very start. Do you believe in market timing? And again, I think, understanding what, that question means. There's reasonable amount of evidence to show that market timing simply doesn't work, not to mention that it's less tax efficient. But this chart here will show you going back from 1970 through 2006, and you'll notice the annual rate of return that includes the darker green line, and the lighter green line is your annual return minus the best month. So strictly trying to time the market. And you can see a significant reduction in your overall rate of return if you stayed invested, at least in your strategy, versus financial advisor. I feel like the market's at an all-time high. I want to go to cash, or I want to sell. And then now I think it's a great time to get back in. I want to get back in. And then I want to get back out. Historically, it's been proven time and time again that just simply does not work. And so I think it's important to talk about this again with a financial advisor and understand, what's your thought on this? Do you have stop losses on your positions? Do you believe in going to cash? And again, this is going to allow you to get a good understanding of whether it may be a good fit with a particular financial advisor. How often do you trade? Speaking for us, I would say probably less often than you would think a portfolio manager or advisor should. If we have new cash to invest, that's going to get traded. If you need cash from your portfolio for living expenses or the like, that's going to be a trade. But again, we don't want to get into a situation where we're trading based on short-term news, emotional decisions. We're looking out 3 to 5 years and saying, we've identified and done extensive due diligence on a particular investment, and we want to make sure that we give it a full market cycle to do what it's supposed to do. Doesn't mean that events don't happen where things change, and we do want to make some tactical changes. But I think it's important not to get overly active with your trading, not to mention, again, transaction costs, taxes. So you can see here the importance, though, of rebalancing, and that is the type of trading that we do. Once we've built out that allocation, you can look at, if you would have owned at the end of 1996, 50% stocks and 50% bonds in your portfolio, and did not rebalance, by the end of 2006, you would now have 62% in stocks and 38% bonds. And by the year 2016, 69% stocks and 31% bonds. Where I see this happen is someone is in a 401k plan at work, a 403b. Back in 1996, retirement feels very far away. They invested it into an allocation 50-50 that they felt was very reasonable from a risk standpoint. Didn't really pay attention to it anymore, didn't rebalance. And over time, stocks have grown more than bonds. And suddenly in 2016, the client who thought they had a reasonable balanced 50-50 allocation now finds himself with basically a 70 stock, 30 bond. And if the market has a significant downturn, they're exposed to very significant losses right before retirement. Big problem, and something that's important to make sure that you're doing. And again, managing risk with portfolio rebalancing, the risk and return of rebalancing versus not rebalancing. Again, it's very important. If you look at that risk metric going back and the return metric of the non-rebalanced portfolio in that light green versus the rebalanced portfolio. The rebalanced portfolio has significantly less risk metrics over that period of time. And it's something, that it's very important to build that out, as we looked at that last slide, to get an understanding of when you're going to retire, when you reach your goal, when you will be utilizing your rebalancing. Once a year, twice a year, quarterly. There is an optimal level for it, and you can overdo it, but that's something to talk about with your financial advisor. How do you report investment performance? Very important. Often clients will come in discussions and they have collections of statements and often don't really know whether they've made any money. So you want to make sure that you're getting frequent performance reports, quarterly, I think is a minimum. If they have an online portal so that you can access your performance, that's important. Not that you want to look at it daily, but you do want to have the ability, it's your money, to access real-time information. I think that's very important. And are fees being reflected in your performance results? It's important to know if costs and fees are reflected and what that would look like. So making sure you're getting transparent performance reports are a very important question to ask a prospective advisor or your current advisor. What professional credentials do they have? Credentials do not necessarily dictate whether an advisor is skilled or whether an advisor is doing what they need to do for you in your best interest. But I will say there are some designations that are a little bit more prestigious than others, and certified financial analyst, CFA, a certified financial planner, CPAs. Those are some of the highest credentials in our business. The certified financial planner practitioner, it's the standard for financial planning. And it is the most straightforward bar to clear for financial planners, in our view, who want to be taken seriously. So, it shows a commitment to continuing education on your behalf and high ethical standards and determining what is best suited for your long-term financial goals. So I certainly would be asking that question about some professional credentials. And then finally, what's an estimated return that I can expect? What is a reasonable estimated return for my portfolio? You want to make sure that lines up with your expectations. I show this chart that will give you an idea of different asset classes going back to 2002, so that you get a feel for what the annualized rate of return would be for these specific asset classes. And then if you owned a diversified mix, which is that line there in the middle of the screen, what would be a reasonable allocation? And so you can see going back from 2002 to 2016, the annualized return is around 7% for a diversified mix of these types of assets: real estate, emerging markets, small cap US, developed markets, commodities. Understanding that mix and making sure that your rate of return is what you want it to be, and that your advisor can achieve it based on your risk, really will help you get an understanding of how to benchmark your performance. And so that's something that we talk quite a bit with our clients. And again, you can see here diversification again in the average investor. Going back the last 20 years, you can see real estate has averaged 9%, US stock market, S&P 7%, 60-40 mix, 40-60 mix, gold bonds, Europe, oil, homes. But the average investor, according to analysis by Dalbar, looking at mutual fund sales, redemptions, exchanges month by month, would show you the average investor during that time period only received a 2.3% rate of return. And again, a lot of that has to go back to investor behavior, market timing, and some of the things that we talked about that you want to make sure your advisors aren't doing, and that you achieve the rate of return that you would like. So today I covered one specific topic in the area of investment management, but we at OJM have expertise in a number of areas. We have a multidisciplinary team that includes attorneys, CPAs, CFPs, MBAs, investment and insurance professionals. Thanks for watching.
OJM is a multidisciplinary wealth management firm, and we have worked with over 1,000 clients throughout the country. We work in 3 different divisions for our clients: investment management, consulting, and insurance benefits. We would welcome the opportunity to speak with you about how we might be able to bring value to your wealth planning. As I mentioned at the beginning of the webinar, our principals have authored several books, all of which are available to webinar viewers at no charge. You can get a free hard copy or ebook download for Kindle or iPad by visiting ojmbookstore.com and entering the code OJMWEB at checkout. In addition to a free book, OJM Group also offers webinar viewers a complimentary consultation where we can answer your questions and see if our firm might be a good fit for your situation. Visit ojmgroup.com or call 877-656-4362 to schedule your free consultation. Enjoy the free copies of our books, and we hope to have the opportunity to speak with you. Thanks for watching.